Good afternoon to everyone. Before I close this afternoon's program, let me show you the summary of our forecast for the rest of the year. In 2020, the Philippines registered the worst economic performance since the country started releasing growth data after World War II. We ended the year with a 9.6% contraction in our GDP. The advent of 2021 gave us a glimmer of hope, even in the face of continued uncertainties and the unrelenting battle against COVID-19. Our first quarter 2021 GDP improved to negative 4.2% from negative 8.3% in the fourth quarter of 2020. However, the early signs of recovery were halted due to the surge of COVID-19 cases and the subsequent lockdown of NCR Plus in March. The recovery we have all been expecting sputtered, but our economy has remained resilient. The country has maintained its credit ratings, and we continue to have a strong and healthy banking system with ample foreign reserves and adequate fiscal stamina. Today, as you've heard from our speakers, the good news is we believe we are ready to switch gears from resilience to growth. The faster global economic recovery, accelerated vaccine mobilization, sustained supportive fiscal and monetary policies, and the government's commitment to push infrastructure projects are expected to fuel our growth. With its high multiplier effect, the infrastructure spending program of government will be one of the main drivers of growth. Our dependable and resilient OFW remittances and BPO services are also projected to perform better this year and support our economy. As employment starts to pick up and more people get inoculated, consumer confidence is also expected to improve. The upcoming election next year is likewise anticipated to support growth. As shown earlier, historically election years are good years for the stock market. To echo Dr. Abola's forecast, GDP is projected to expand by 5 to 6% this year, which is good news indeed. In the equities market, positive investor sentiment is back, as evidenced in the success of recent issuances and the recovery of the index sans foreign investors. A healthy pipeline of offerings and a new asset class, the REIT, are expected to stir excitement and interest in the investing community. The rise of retail investors in the local equities market is driving liquidity and moving the market. We also think foreign investors are set to come back as favorable market conditions come to light. We expect the PSE index to reach 7,400 to 7,800 by the end of the year. In the debt market, longer tenors are opening up, which means investors are willing to take more risk for better returns. With a steepening of the yield curve, we know, generally speaking, that's also a sign of a growing economy. We are seeing a lot of positive signs and reasons to believe that the country is on its way to recovery. But this is not to say we should let our guards down. And as the saying goes, we may have been shaken but not stirred. Still, the biggest risk to our outlook is the uncertain course of the pandemic. We should continue to be cautious and mindful and do our share in controlling the spread of the virus, which we should have all mastered by now. On behalf of the First Metro Group, I would like to thank you for joining us this afternoon, and we hope to see you again in the next briefing. Stay safe and stay healthy. And as Oliver Cromwell said to his troops, trust in God and keep your powder dry. The markets have more to offer as our economy switches gears from resilience to growth. Maraming salamat at magandang hapon sa inyong lahat.